Hello, welcome to preparation of financial statements. We'll see once again the preparation of cash flow statements showing cash from operation, cash from financing and cash from investment, when the other information given is balance sheet, opening balance sheet and closing balance sheet, income statement and cash flow statement showing the receipts and payments. So we like to convert in this session this cash flow statement into CFO, CFF and CFI, and also try to answer this question why CFO is not same as PAT. In other words, we will try to prepare CFO using the direct method and also prepare CFO by using the indirect method. So CFO by using the direct method shows the cash inflows from operating minus the cash outflows from operating. So in this case, expenses minus the tax is the CFO minus 47,200. CFF, there is no cash inflow, but there is a cash outflow of interest and the dividend. CFI, there are no cash inflows or cash outflows. So in this question, the CFO is minus 47,200, negative CFO and negative CFF, and no CFIs. Now let us try to see why the company is having a negative CFO when the PAT is positive. So PAT is positive here. Why CFO negative? The CFO is not same as PAT because of non-operating items like interest, non-cash items like depreciation, and the credit items like outstanding expenses, creditors, debtors, purchase of stock. So we'll make adjustment for depreciation. So depreciation is add back 8,000. We add back because we have deducted depreciation 8,000 while computing PAT. We add back interest because we have deducted interest while computing the PAT. Outstanding expense. Whenever there is an opening balance sheet and closing balance sheet is given, we can understand whether the changes in outstanding expense which will show whether cash has been paid or not paid. So in this case, the outstanding expense has reduced. So that means we paid money during this period 8,000. So decrease in outstanding expense, decrease in outstanding expense has happened here, which means that there is a payment to the extent of 8,000 which is not shown in the income statement. The creditors have increased. So increase in the creditors, that means we purchase goods on credit, increase in creditor. So purchase goods on credit, so no payment has been made, so plus 50,000. To that extent, payment has not been made. Debtors, increase in the debtors, that means we sold goods on credit, so minus 180,000. Similarly, the stock, decrease in the credit stock, that means the goods which have been purchased in the previous year have been used in the current year. So as a result, you can see that we arrive at the PAT. PAT is 44,800 and CFO is negative 47,200. The difference between the PAT and CFO is because of non-cash, non-operating, and the changes in the current assets and current liabilities, which are also called the credit items, but we give a name to that They're called the changes in the current assets and current liabilities. So therefore, CFO is not same as PAT because of non-operating, because of non-cash, and because of the changes in the current assets and current liabilities. Thank you very much.